I'm Sean Cooper, president and owner of Fit Financial Consulting, LLC, a registered investment advisor. Last week we talked about non-qualified accounts, and this week we're going to be talking about qualified accounts. And because qualified accounts come in a wider variety, we'll go through each one in detail, but we'll start with kind of a general overview, but predominantly sticking to retirement accounts. So we'll be talking about IRAs, 401ks, SEPs, Simples, 403bs, 457 plans, and even some defined benefit plans. All of these plans, though, allow you to set aside money for retirement, and they allow those funds to grow on a tax-deferred basis, meaning you don't have to pay taxes on an annual basis. Additionally, these funds allow for either a tax deduction in the year that you make a contribution, or allow for tax-free withdrawals once you withdraw the funds in retirement, as would be the case with a Roth. Because of all these tax benefits that they allow for, the IRS imposes some pretty stiff tax penalties if you withdraw money prior to retirement or for any reason other than retirement. There are a few exceptions to that for extenuating circumstances, first-time home buyers, some other things if you fall ill and things of that nature. But for the most part, any withdrawal prior to age 59 and a half is going to be taxed at your income tax bracket plus an additional 10% penalty, which means you can end up owing quite a lot for tax pre-retirement withdrawals. Roths, again, would be a bit of an exception to this. The taxability, it only applies to the earnings on the funds that you withdraw. So your income tax bracket plus a 10% penalty only on the earnings. But these are just the general rules that apply to these accounts. Next, we're going to jump into some of the more specifics for each type of account. The first retirement account that we'll discuss is IRAs, or individual retirement agreements, since they're the most common. If you are a U.S. citizen and you or your spouse have income, taxable income specifically in the year, you can probably contribute to an IRA. Now, IRAs have contribution limits of $6,000 in 2019, or an additional $1,000 if you're over age 50, allowing you to contribute $7,000 total. Like many other retirement accounts, the IRAs allow for tax deductions in the year that you make the contributions. They effectively reduce your taxable income for the year. Now, that only applies up to certain income limits. If you're covered by a retirement plan at work, you can only take a tax deduction for IRA contributions if you're single and your income is less than $64,000. Anything between $64,000 and $74,000 is going to be a partial deduction, and income over $74,000 allows for no deduction. You can still make a contribution, you just won't get a deduction for it. If you're married filing jointly, then the cap is going to be $123,000 for no deduction, a partial deduction between $103,000 and $123,000, and a full deduction as long as you're making less than $103,000 for the year. If you're not covered by a retirement plan at work and you're filing singly or head of household or as a widower, then any income you make will still allow for a full deduction for IRA contributions. If you're married and your spouse is covered by a retirement plan at work, then the income cap is $203,000 for before you can't make before the deduction or contribution no longer allows for a deduction. Anything between $193,000 and $203,000 is a partial deduction, and as long as you make less than $193,000, you can take the full deduction. Now, if your spouse is not covered and you're filing jointly, then again, any amount is deductible. So any income level will still allow for a full deduction. Regardless of whether or not the contribution is tax deductible, the funds inside of the IRA are still going to grow tax deferred. With that said, they are going to be taxable when you withdraw them in retirement. And if you take early withdrawals, so anything prior to age 59 and a half, you're not only going to be taxed at your income tax bracket, but the IRS is going to impose an additional 10% penalty. On top of that, because of the tax benefits of the IRA and the fact that you got the tax deduction early on, the IRS eventually wants their money, and they're going to force what is called an RMD, or required minimum distribution, once you reach age 70 and a half. So they force you to start taking withdrawals so that you essentially have to pay taxes. The other version of an IRA that you may be familiar with is a Roth IRA. This is essentially the opposite of the traditional IRA, at least from a tax standpoint. So contributions to a Roth IRA have separate income limits. If you're married filing jointly, you have to make less than $203,000 in order to contribute to a Roth IRA at all. So it's not like the traditional IRA where you can still make the contribution, you just can't take a deduction. With a Roth, anything over $203,000 you cannot contribute at all for married filing jointly. Between $193,000 and $203,000 is a reduced amount, and less than $193,000 allows for the full contribution. If you're single or head of household, then the income limit is $122,000 for a full contribution. Between $122,000 and $137,000 is a reduced amount, and anything over $137,000 does not allow for a Roth IRA contribution. The other way that a Roth is different is going to be in regards to the tax benefit. Like I said, first off, there is no tax deduction in the year that you make a contribution to a Roth IRA. It still grows tax deferred. The big differences, though, are there's going to be no RMDs because the IRS hasn't really given you a tax benefit, so they don't care if you start making withdrawals at age 70 and a half. The biggest advantage is there is no taxable income from a Roth IRA. So when you start making withdrawals in retirement, there are no taxes on those withdrawals. Early withdrawals prior to age 59 and a half will still receive a penalty, but only on the earnings in the Roth IRA. And your taxable income will also apply to the earnings if you take early withdrawals. 401ks are probably the next most common type of retirement account. And they're very similar to IRAs, but with very different contribution limits. So in addition to that, only companies can open 401ks. Individuals cannot open a 401k unless, of course, you're a sole proprietor, but then technically it's still the business opening the 401k. But as far as the contributions are concerned, you as an employee can contribute up to $19,000 in 2019 to a 401k. If you're over age 60, you can also contribute an additional $6,000, bringing the total to $25,000. The company match, so the employer match, can actually be effectively anything that they choose, but some of the most common matches are around 3, maybe 10% on the absolute high end, and that's of your income, and that's only if you make a contribution. So another common match would be like a phased match, where they'll match up to 100% of your income up to 3%, or 100% of your contribution up to 3% of your income, and then 50% of your contribution up to another 3%. So bringing the total match, if you contributed 6%, to a match of 4.5%. So 3 on 3, and then 1.5 on the other 3%. So those are just some common examples. Regardless of how you square it, the combined total contribution limits in 2019 is $56,000. Again, if you're over age 50, the total contribution limit is $6,000 higher, so that's $62,000. As you can imagine, based on these contribution limits and the way the matching works, it's not very often that you actually hit the overall contribution limit from the company's match. The way that most often happens is actually through what's called a profit sharing plan, which is an additional contribution that the company can make at their discretion based on profitability and when it's financially feasible to do so. But as we talked about, just like the IRAs, your contributions to a 401k are still going to be tax deductible in the year you make the contribution with no income limits. It's going to grow tax deferred. There'll be a penalty if you withdraw it early, most likely. And it's going to be taxable when you start to withdraw the money in retirement. Some of the other big differences, though, are going to be the fact that many 401ks allow for loans on your account, so you can actually pull the money out provided there's some kind of repayment plan. without receiving the tax penalties for doing so. But again, that's based on the fact that you're going to repay it over a certain time frame. 401ks also have a little bit of difference in regards to RMDs. Instead of it being at age 70 and a half, it's the ladder of age 70 and a half or retirement. So if you work beyond age 70 and a half, RMDs don't kick in until you actually retire. Additionally, 401ks require a variety of reporting. So annual reporting to the IRS. They also require an annual meeting to inform employees that the 401k is available and explain it to them. And because of these additional requirements, it often behoove the employer to employ a TPA or third-party administrator on the plan to keep them in line with regulations. Unfortunately, this does cost anywhere from typically $1,000 for very small plans, or potentially tens of thousands of dollars, or even hundreds of thousands of dollars for very large plans. But those fees are typically based on the number of participants and then also the total assets under management. One of the other big differences with 401ks is going to be the investment options. So with your IRA, depending on who you open the account with, you'll most likely have essentially the entire universe of investment options available to you. With a 401k, on the other hand, you'll probably have 30 funds on the high end, and they're going to be dominated by target date funds, domestic equity, some international equity, and probably some domestic bond funds. So kind of a limited scope in terms of investment options, but one of the other differences there. 401ks also have a Roth version, much like the IRA has a Roth version. And just like the Roth IRA, it's going to contributions to the Roth 401k create no tax deduction in the year that you make the contributions. They still grow tax deferred. There's still a penalty on earnings if you withdraw them early. And again, they are tax free when you start to make withdrawals in retirement. Some of the less common retirement plans are going to be your SEPs and Simples. So a SEP is a simplified employee pension. These are typically most suitable for self-employed individuals or sole props, or people who have very few employees. And the reason being is they operate much like a 401k from certain standpoints, but with a few key differences. So they have the same contribution limits as a 401k, which means as a self-employed individual, it gives you that larger cap, which is very nice. However, contributions are only made by the employer, so no employee contributions can be made. That's why the sole prop kind of benefits from it, because you're only essentially contributing to yourself as a sole proprietor, or even a individual practitioner of an LLC or something along those lines. When you have lots of employees, on the other hand, it tends to become very, very expensive very quickly, because although the contributions are not obligatory, meaning you don't have to make contributions in any given year, you only have to do it when it's financially feasible, you have to make equivalent contributions to yourself and all your employees when you choose to do so. So if you contribute 20% of your income, you have to contribute 20% of all of your employees' income as well, provided they meet the participation requirements. As you can see, that creates quite a bit of flexibility, but again, it can become very expensive as you increase the number of employees, and that's why it tends to be best for sole proprietors. Savings incentive match plan for employees is essentially exactly what it sounds, and it works better for those companies that do have quite a few employees. So this is the simple, and it is simple in many ways. First of all, the rules are essentially laid out. There are fairly few options or limited options that you as an employer choose between. So unlike the 401k where you can choose the contribution, or the SEP where you choose if you're going to make a contribution at all or not, you have two options. Number one is a 2% obligatory contribution to every one of your employees. The second is a 3% match. So the 2% obligatory contribution, you make that every year, 2% of their income, regardless of whether they contribute or not. The 3% match is only a match if they contribute. Additionally, the 3% can be modified somewhat. So you can actually reduce the 3% as low as 1% as long as you don't do it more than 2 out of every 5 years. So a little bit of flexibility, but for the most part, the rules are pretty strict. As far as you as an employee, contribution limits are quite a bit lower. So it's $13,000 in 2019, and then if you're over age 50, you can contribute an additional $3,000. Everything else is essentially the same. You still get a tax deduction in the year that you make contribution. There are no income limits for that tax deduction. The funds grow tax deferred. There are tax penalties if you withdraw the funds early prior to age 59 and a half, and the funds are all taxable once you withdraw them in retirement. So, few key differences. Everything else is pretty much the same as what we've been talking about. The other types of accounts that I don't want to go into too much detail on are going to be your 403Bs and 457 plans. These are essentially the nonprofit and government versions of 401k. So they're the 401k equivalents for nonprofits and governments. So essentially the same rules apply. There may be a few key differences, but more than likely those are outlined in the plan documents. So you'd actually want to refer to your specific plan documents to figure out what those are. So far, these have all been defined contribution plans. That means the employer's obligation is defined by their contribution. So their only obligation is what they have said they're going to contribute. This really limits the liability for the employer, which is why they've become so popular. The other type of retirement plan that we haven't talked about is a defined benefit plan. And the most common type of defined benefit plan is going to be a pension. Now, as you can imagine, because the employer is obligated to meet the defined benefit, what they are committed to giving you once you retire, either a set amount on a monthly basis or annual basis once you retire, this creates a great deal of risk for the employer because they have to make sure there are funds to match that cash outlay on an annual basis for people that may end up living 20, 30 years longer than expected. And so they also have to account for market volatility and things of that nature. Because of this added risk, pensions and other defined benefit plans have really gone the way of the typewriter. They're not utilized much anymore. The one exception to that would be a cash balance plan. So instead of meeting a specific monthly obligation or annual obligation, it's just a set amount that they are saying is going to be in your account when you retire. What you do after that is your concern. This is more common and works best for older employees who want to stash away lots and lots of funds, something above and beyond the 401k contribution limits, that have relatively young workers, so a relatively young workforce. So I won't go into any more details on that particular plan just for time's sake. And next week we're going to be talking about college savings plans. But if you do have any questions on anything we've discussed, by all means, give me a call, shoot me an email. My number is 720-808-6979, and my email is sean.cooper@fitfinancialconsulting.com. Thanks.